This will be available on all your favorite podcasts under that Lead Lag Live banner. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Jason Burack. Jason actually was watching some of your videos with the Rebel Capitalist who I had on before, so I'm excited for this conversation. Introduce yourself here for the audience. Who are you? How'd you get interested in markets? And what are you doing with your research?
I've been a financial professional for 15 years now. I was initially just a stockbroker. I had bad luck. It was during the 2008 financial crisis. And I've been reading a lot of investment books along the way, interviewing a lot of experts on my YouTube channel. I've interviewed over 500 experts on in-depth interviews. They're in the archive. A lot of big name investors like Jim Rogers, James O'Shaughnessy, Doug Casey, many, many others on a lot of interesting topics. I've actually been covering cryptocurrencies, Bitcoin, since 2012, but I'm more of a value investor guy. But we do have a weekly This Week in Chart show that my friend Aaron, who's a cycles trader, also does. It's a global macro This Week in Chart show. I think it's very good. We try to do it in under 20 minutes, a global macro wrap. And so for 15 years, I've been a financial professional. Like I said, I started off at the bottom as just a basic salesperson and as a stockbroker during the 2008 financial crisis. I got interested in markets because my grandmother inherited when my grandfather died in 2007 or 8. Can't remember the exact date. It's been so long, but she inherited a bunch of really bad investments. She was sold by Wall Street, like mortgage-backed securities, real estate investment trusts. There were millions of dollars in there and they collapsed down 70, 80, 90%. And so I started asking a lot of questions during the 2008 financial crisis. And then also I was an investment analyst in the past at a paid newsletter company. And I covered small caps, dividend stocks, oil and natural gas. Most of my focus right now, though, Michael, is on a global macro and commodities. I'm also a contrarian value investor. So if there's a sector down 70, 80, 90%, I'm looking to go in there, top down global macro analysis, and then bottom up and look for severely undervalued assets that are mispriced.
I'm going to assume the answer is no, but are we at a point in the crypto space where they're severely undervalued to the point where they are actual values? And let's separate out crypto from Bitcoin for that conversation.
Well, how do you value something that doesn't have free cash flow and profits? So that's part of subjective value theory with Carl Menger. I'm an Austrian school economist, so it is far easier for me to look at something with businesses that are hated. So fertilizer companies or uranium companies or gold royalty companies, which have free cash flow right now. These companies don't do any gold mining. They actually help finance base metal miners when these base metal miners get in trouble. So copper miners who need some extra cash because they have balance sheet problems and their mines just went cash flow negative 8 to 12 weeks ago. So crypto is different to value. I don't view crypto as an investment per se. I view it as speculation, and I monitor social media. So the way I look for it is sentiment. The last time I thought crypto was an absolute screaming buy, Michael, was, I would say, in early to mid 2020, because crypto had been in a bear market. Since I've been covering crypto since 2012, 2013, people can go in the archives on my YouTube channel, which has almost 2,000 free videos and over 500 experts, 50,000 YouTube channel subscribers, almost 10 million views. And they could go in there and look in the archives that I've been covering crypto for a long time. So traditional value metrics don't work on crypto. I don't think it's a buy now, Michael, because I think there's a serious counterparty risk problem with all these centralized exchanges, these Bitcoin exchanges and other crypto exchanges. I think we're still early to mid stages. I don't know if you saw the news stories coming out, but it looks like there's a $2 billion emergency fund from the CZ Binance guy. I don't think that's going to be enough. We're just seeing almost every day, we're seeing headlines with just problems with a lot of these cryptocurrency exchanges. And from speaking with former CPAs in Silicon Valley, it looks like there was clear account, besides just the FTX, which was a blatant fraud, it looks like there was also accounting fraud, blatant accounting fraud with these FTT tokens. So I don't think we're at the end stages of that. And I think that's going to scare away a lot of institutional investors. I know they're calling for more regulation, but People are still getting margin calls. People's accounts are being frozen at other exchanges. It's just a mess right now with these centralized exchanges. Also hearing that there's problems with the Grayscale Bitcoin Trust. There's a lot of serious red flags that have been raised over the last 12 to 14 months that people ignored, that people are starting to look into now. There's problems with Silvergate that Mark Hodes is highlighting. Silvergate is, I think, like the main corporation that lent to a lot of these Bitcoin exchanges and crypto exchanges. So there's all these problems are going to have to be worked through. And I think sentiment is going to be negative in Bitcoin and a lot of crypto for a while. I don't know if it's 6 months. I don't know if it's 12, 18, 24 months. But normally these cycles, these bear cycles, they don't end in 6 months, especially with the problems with the exchanges and Silvergate and the Bitcoin Grayscale Trust and Tether.
All right, so we're going to expand that. I want to go back for a moment. So you mentioned you've been a financial professional. That term is always interesting to me because, I have to tell you, I've met a lot of different people in the industry who are the furthest you can imagine from being professional. I think there's this vision out there that those that are in the industry seemingly are more even keel, are not like retail. And from my experience, a lot of financial advisors, investment advisors, honestly, are knuckleheads, right? They honestly, no, I'll be honest with you. And I present.
Well, it's a sales job. A lot of it's sales. Come on, let's be honest here.
That's where I'm going. No, that's the point. So I want you to talk through the audience your experience as far as, first of all, how do you really define what a professional in the industry is? Because exactly to your point, there is a lot of sales, okay, and that's because everyone's trying to raise assets. And there's also, I would argue, a lot of momentum chasing, meaning I've met a lot of financial advisors who are no different than the retail that is supposed to be worse at managing money than they are.
Well, I'm kind of old school, so I like doing fundamental analysis. I like looking at things that people say they never want to touch. So if I see on social media, people say, I hate gold, I hate silver, I hate gold stocks, I hate coal stocks, I hate oil stocks. These things start to interest me if I see a lot of people posting and hating. And then I start doing research on these companies, and there's actually some bargains there. I mean, there's some coal stocks, and coal is hated. And we all know that the politicians, bureaucrats, regulators, they all want to ban or restrict. They want to ban drilling. They want to phase out a lot of these fossil fuels. But meanwhile, China is just building new coal-fired power plants still, or at least they said they were going to start building more coal-fired power plants. And the coal imports, the coal prices are very high. So this is the type of analysis I do. So as a financial professional, I'm doing the old school Benjamin Graham, Warren Buffett. It's very difficult to do that, though. I know you're not the traditional classic value investing, like the Seth Klarman book, Margin of Safety. I don't know. It's not Margin of Safety. Shoot, I forgot it off the top of my head. The Seth Klarman book says it might be Margin of Safety. I'm drawing a blank right now. Says not to buy commodity stocks or natural resource stocks because of CapEx. But I see severe underinvestment on the supply side in commodities, not because of free markets, not because of capitalism, but because of bad government policy that has restricted oil and natural gas drilling. It takes 15 or 20 years in some countries to get all the permits and capital costs approved to build a new mine. So these problems are going to restrict a lot of commodities supply going forward. So the type of analysis I do, like I said, I worked at a paid newsletter company in the past that was competing with Agora Financial. So it was a pretty big one with tens of millions a year in sales. And I covered like oil and natural gas stocks with one of the largest oil and natural gas newsletter writers I work with, Robert Rapier.
Okay, and we're going to expand on that too. I want to hear your thoughts on, since you mentioned that you've interviewed all these, fairly big names in the industry. You and I both know that interviewing somebody is a very different skill set than being interviewed. I mean, I know that myself, having done a lot of these spaces now over, the last year or so. I'm curious, do you find that bears make the best interviews because they sound smarter, they sound more together with their facts versus, bulls, which are demonized as being perma?
That's a really good question. I tend to look at people's track record. So I'll go back and look and see if someone is always like perma bullish, like you said, if someone's always perma bullish on Bitcoin or always perma bullish on gold, always predicting $2,000 an ounce gold every couple months or something along those lines, what their track record is. So before I interview someone, I'll normally go back and look, and then I did go to law school too. So before I started in the financial industry, I did actually go to law school. So I think I can do a pretty decent cross-examination. If your listeners go and look up my archives, my long interviews, I kind of ask people tough questions because I ask people questions that I want answered. So if I have like serious questions about someone's viewpoint, or I really want to draw out information. So like I'm interviewing oil analysts about like OPEC production, about Saudi Aramco, how Saudi Aramco is bringing on much higher. This is an example of this. I interviewed like the top oil hedge fund manager, Josh Young, a couple times in the last like 12 months. And I'm drilling down and asking him questions about Saudi Aramco and how their major oil field, Ghawar, how they're replacing a lot of that lower cost oil that was $10, $20, $30 a barrel with higher cost oil production that's deep water offshore, that's $35, $40, $50 a barrel now for production costs. So those, I'm asking more difficult questions because those are questions I want answered. I'm trying to figure out how to generate alpha for my listeners. And those questions are dealing with, often with commodities, with supply and demand, trying to figure out what the real supply and demand is. Because I think that one of the key things we hear now all the time, Michael, the last like 6 to 9 months is demand destruction. That phrase for a lot of the commodities is just mentioned constantly, but there's not a lot of demand destruction for a lot of these commodities, especially food and energy. So, and then there's also very severe, I would say, supply side problems for a lot of these energy related commodities over the next 3, 4, 5, 7 years.
But I love the point about cross-examination. So I've always been fascinated, actually, this is more of a side note, by the way lawyers will construct an argument. There have been studies that show that if you have a case with similar facts, if one case has a lawyer that's able to create a narrative around the facts, while the other case, the lawyer doesn't have as strong of a story with the same types of facts, the one that has the narrative with the facts tends to get the verdict that they want, right? In other words, there's a lot of studies that would suggest that you've got to really kind of string the facts together for people to really understand, rather than it being obvious. You've got to create a narrative around it, which is funny because I always rant against narratives. The narrative here, which, as you alluded to, that's been going on for a while, is that there's tremendous underinvestment in commodities, oil and gas. Those are going to keep going higher. We've got geopolitical risks. Talk us through the other side of that, because I think there is an assumption that you're in a secular bull market for commodities because of this underinvestment narrative. Is there any way that that's wrong?
So all these commodities have different supply and demand fundamentals, but oil and natural gas are some of the main ones because they're used in so many different things. And a lot of oil related things have been replaced with natural gas over the last couple decades. So those are kind of the master resources for energy. But you're seeing this now with the earnings over the last couple quarters with a lot of these companies. And it's not just mining companies or agricultural companies or fertilizer companies. You're seeing this with all these companies. It's affecting their profit margins. It's affecting their earnings. One of the main things that they're bringing up on the conference calls is rapidly rising costs. And that's because it's not just of all this currency that governments and central banks created over the last 2.5 years. And it wasn't just the US. All these governments basically created many trillions of currency units, and the economy with the lockdowns did not create as much supply. And then on the commodity supply side, you have certain commodities where it's just a lot more difficult to bring on supply. So each commodity is different. You want the bear thesis for commodities. The bear thesis is short term. So it depends on policy. If governments are going to ban drilling, okay, in the short term, some of these commodities could react violently to that. If governments are going to issue windfall profits taxes on an oil company in a certain country, you're going to see those shares come off enormously. I think you saw that recently. There was a large scare with Petrobras in Brazil. I mean, that's been like the darling dividend play because they're paying out around 60%. It might have been a little over 60% of their free cash flow to dividends to all shareholders. So they were throwing off enormous amounts of free cash flow. Their dividend yield was over 20%. And those shares, just based on an election, because the market is worried about ESG policies, the market is worried about windfall profits taxes, those shares dropped enormously in a very short amount of time. So I think it depends on each individual commodity supply and demand fundamentals, but we've had politicians, bureaucrats, regulators really muck up I would say the permitting process, the ability for a lot of these commodity producers. So if you run an oil and natural gas company here in the United States, and every couple days you hear President Joe Biden or someone in the Biden administration say, we're going to phase out oil production, or we're going to ban drilling, or we're going to put windfall profits taxes. We're going to do all these things that are going to either tax you, hurdles, red tape, ban drilling, ban pipelines. You're not going to want to make many billion-dollar investments into new supply. So in the short term, yes, you could see oil prices go down more, but we've seen over the last 6 to 8 weeks, we've seen comments from the Saudi oil minister and the Nigerian oil minister, other OPEC ministers, talk about how they will be more aggressive with oil supply production cuts. Maybe there's another 1 million or 2 million barrel per day oil production cuts. So we might see some demand destruction out of oil, even though it looks like China is going to be opening up a bit. But we could also see OPEC more aggressive with supply production cuts. But really, Michael, on the fundamental analysis side, the numbers, the OPEC reports, the data we're getting out of OPEC and OPEC Plus since August on its own. So they were maxing out oil production through August, but in August, production started to collapse on its own. They can't run. It's like an engine in a car, and you're running max red line there, and you're going to run out of gas. You're going to stall the engine. You're going to cause all these problems eventually if you put pedal to the metal constantly. It looks like OPEC is kind of hitting that wall there. In August, oil production was down, I think, almost 4 million barrels per day. And September, it was either September or October in the new report, production was down over 3 million barrels per day on its own. This was without OPEC announcing another oil production cut. So in the short term, yes, the bearish thesis, maybe we see more demand destruction, but then over the next 2, 3, 4, 5 years, the cycle is going to be picked up because we did have commodity prices high for 18 months? We had commodity prices high, although the mining companies benefited from low oil prices for about 12 months in 2020. But now that commodity futures contracts the last 6 to 8 months are down enormously, there's not the incentive to invest in new supply. Also, for a lot of these mining companies, Michael, there is not capital available, especially for base metal miners. And a lot of these base metal miners over the last 8 to 12 weeks, they are cash flow negative.
Yeah, and so this is, I think, an interesting angle around metals and gold in particular. Because as you exactly alluded to, right, the supply and demand fundamentals are different depending upon which commodity you're looking at. Is there a real underinvestment case when it comes to gold, and how does perhaps all this focus around ESG maybe impact that? Because I'm going to assume that from an ESG perspective, gold is not a very popular commodity to mine.
So most of the gold mining production, and I cover gold miners extensively for my patrons on my behind the paywall there on my Patreon. And there's almost 250 articles covering a lot of these commodity companies over the last 2.5, 3 years. Most of the annual gold mine production is actually now from these open pit, low grade copper mines, and the gold and the silver is a byproduct. So that makes up the majority of the annual supply. And these low grade copper and gold mines, and by low grade, I mean like the average gold grades are about 1 gram per ton. Some cases are even less than that. We're really scraping the bottom of the barrel compared to decades ago for the actual grades of the gold. And these open pit, low grade copper and gold mines are using enormous amounts of diesel, electricity in a lot of these emerging markets, Michael, where their local currency is getting very weak against the dollar. So we've had the strong dollar now, the dollar rally for the last, 9 months since the beginning of 2022. That means a lot of inflation in emerging markets. And that normally means in the mining industry, the workers want higher wages to offset inflation. So even if the metals prices are falling like a rock and you have the deflationistas saying demand destruction, you have at the mine site, if you're running a mine, it's actually the worst of both worlds because your energy costs, your diesel costs are up enormously. The US oil refiners are really exporting lots of diesel all over the globe. A lot of these other oil refineries in other countries are not either maintaining production or increasing their production of diesel. So it's really the U.S. oil refiners that are exporting a lot of this diesel. Diesel prices all over the globe are still high despite oil prices falling over the last couple months in a big correction. And then you have electricity prices in a lot of these other countries. They're up enormously in the last 2.5 years. And miners, they're using an enormous amount of diesel, electricity, chemicals, and a lot of manpower to just separate out a lot of this rock that has almost very, very low grades or almost no grades, totally uneconomic, a lot of this rock, copper and gold. So the ESG component, the ESG tends to be fairly anti-mining. So if a country is overly ESG, they're not even going to allow mining. If they're hardcore ESG, they're not going to allow mining. They're not going to allow fossil fuels. It's going to raise the cost of mining, or the permitting process is going to take years longer. The costs are going to be up. It's going to be almost impossible to do. For the gold mine supply, though, a lot of people say that there's tons of above ground gold, so the gold mine supply doesn't affect the price of gold and supply demand fundamentals. However, I would say that the majority of gold above ground is not for sale. So normally what you've seen in past cycles, Michael, since 2008, 2009, is when the gold miners and the copper miners get in severe financial problems for a couple quarters, say 2, 3, 4 quarters, that either they're in jeopardy of going bankrupt or they're about to turn off the supply, you start to see rallies. So you start to see some type of either a bear market rally or a new bull market. And I suspect that that's what's happening in the gold space, because the gold miners have really been in a mini bear market since the gold price peaked around September 2020.
Yeah, and I'm looking at just some of the gold miner ETFs, and a lot of the gold miners, as you know, haven't really gone anywhere really since the great financial crisis. And that point about oil prices and increased labor costs, I think, is important, and probably people who are assuming that you want to buy gold miners because of inflation are not realizing that inflation actually hurts them, right, in terms of their margin.
It depends. It depends. So if energy costs were cheap now, Michael, so if we had $30, $40, $50 oil and diesel prices fell like a rock and natural gas prices fell and supply became plentiful for electricity, for the grid power, we would have really good profit margins for the gold miners. The gold miners actually had really record profit margins. Our friend Tavi Costa was covering this in 2020. So for about 12 months, gold miners had record profit margins. They had amazing tailwinds because the gold price was over $2,000 an ounce, and the energy costs, oil prices were very negative and bearish, and oil prices were low in 2020. And there wasn't a diesel shortage back then. So I was warning people as 2020 was ending, 2021 was starting, that look, oil prices, diesel prices, electricity costs, we're just seeing all these things in the headlines all over the globe. That's going to kill the gold miners' profit margins. Now, I cover these gold royalty companies. They don't mine. So these companies, they buy a royalty or a stream on a mine, and they finance these mining companies when these mining companies either don't have capital available, either they get stuck financially, they're building a mine and then they can't raise the last amount of capital, say 50 million or 100 million or 150 million extra to get the mine across the finish line to start generating cash flow, or the miner is like a base metal miner and their mine's been cash flow negative for the last 8 weeks or 12 weeks. They're running through the revolving credit facility, and these royalty companies like a Franco-Nevada, a Wheaton Precious Metals, a Royal Gold, what they've historically done in bear market cycles, they're counter-cyclical companies. They generate free cash flow and have much higher profit margins. Their profit margins for a lot of these companies are over $1,000 an ounce right now. So they're not dealing with the same issues that the gold miners are, whereas like a gold miner like Newmont Mining, and Newmont may have bottomed here on the share price if you look at the charts recently, because if gold goes too much lower for these low-grade open pit gold mine, if gold goes below 1,500, a lot of these gold miners with their low-grade open pit copper and gold mines are in severe financial problems because their profit margins will have evaporated and their costs are up enormously. But with the royalty and streaming companies, you don't have to worry about that as much because they have a portfolio of diversified royalties and streams and the costs are fixed. And historically, what these companies have done in bear market cycles, they're counter-cyclical investors. They're 20, 30, 40 people at the company, and they deploy capital to the mining companies, and they buy a slice of the revenues from a mine. And then when the cycle turns, these royalties and streams generate enormous free cash flow. So that's why a company like Franco-Nevada throughout these different cycles has grown so much, especially since 2008, 2009. If you go back and look at a max chart, that while the gold price and the silver price over the last 12, 13 years haven't really done that much, the max chart on a Franco-Nevada since 2009, FNV, is up enormously since 2009. And that's because they've been doing contrarian counter-cyclical investments, and they don't have the capex problems and the profit margin problems that the regular miners do.
I want to go to the name of the space, which I put together purposely. Analog gold is better than digital gold. And I say that because that was the narrative for a few years here, right? That digital gold, Bitcoin in particular, cryptocurrencies, right, were the better quote unquote store of value than gold, and that's the gold of the future. With and obviously we've seen a lot of these narratives taken out one by one. Did you ever buy the argument that part of the reason why gold didn't really move anywhere for the last decade is because of Bitcoin, because of cryptocurrencies?
That's only part of it. I mean, some of the investor dollars. So I've gotten a lot of messages from people over the last, it has slowed down a little bit. But when crypto was really ripping and Bitcoin was at 69,000, I mean, I was getting these messages every day that people were selling their physical gold and silver. They were selling all their gold royalty stocks, their gold and silver mining companies. They were going into crypto. They were chasing higher prices. They'll never buy gold or silver again. But that normally means, from a sentiment perspective, that things were too high. I mean, the Super Bowl commercials. So yeah, gold, the sentiment for gold is negative. Normally, historically, gold does well in currency instability, bankruptcies. Actually, if you want to talk about financial history, one of the best performing times for gold and gold miners was during the 1929 Great Depression. While oil prices were falling, gold prices actually fell less, and the cost for the gold miners was falling during a deflationary depression. The 1929, after October 1929, you had the gold mining stocks that were minting money with free cash flow and raising dividends. Their profit margins were really ripping because their costs were falling and gold prices were not falling as much as everything else. So I think what's happening now, Michael, is you're starting to see lately, over the last 2 to 4 weeks, I would say, you're starting to see more institutional money start to allocate funds to the best gold stocks. So like an Agnico Eagle, a Newmont Mining. There was a lot of dip buying in Newmont Mining after their last Q3 earnings. Their earnings themselves were bad because their mines have problems. But I think that's more of an industry problem, as I described earlier, with the low-grade open pit copper and gold miners, that honestly, if energy prices and electricity prices and labor prices and cost of capital are up, that they're not going to have margins if gold prices don't start rallying again. So the institutional investors have been accumulating the top quality gold stocks over the last 2 to 4 weeks, I think also because of the safe haven factor. So you have money that is leaving crypto, going into gold. You have in certain, it really depends on which country. If you're looking at global macro analysis, because inflation is worse in certain countries than others. With a strong dollar historically, you tend to actually have much worse inflation outside the United States, especially with these energy prices where they are. So inflation is actually really ripping in a lot of these other countries outside the United States, way worse. And we do have stagflation here, and I don't believe in the consumer price index. So I think the inflation numbers are higher, but on a relative basis, I think inflation is way, way worse in developing countries outside the United States. So I think now that people are starting to realize that Bitcoin and crypto, there is some severe risks, especially if you kept your crypto on an exchange, if you didn't store it off a centralized exchange. So that will be good for gold. Also, if we have more currency instability, if we have bankruptcies and failures, I mean, we're seeing Credit Suisse maybe merged with UBS this weekend. I'm seeing that. I'm seeing even more news of that. And we have a lot of investor funds pulling out. They need to sell capital. Maybe they do a reverse stock split. I mean, normally, historically, Michael, these types of things with bank failures and problems are good for gold because then gold starts to catch a bid as a safe haven status. So really, since 2020, we haven't had that. That narrative for gold has not been there. So I think we're starting to see more people start to reallocate some percentage of their capital to gold. The other thing that just came out, the other news item that's worthy is a lot of governments and central banks are selling an enormous amount of US treasuries. And we have a record amount of physical gold buying, according to the World Gold Council, by global central banks. It was the largest amount in Q3 since 1967. So if your listeners are not familiar with financial history, 1967 was the London gold pool, or as people in the gold and silver community call the gold manipulation pool. So that's when the dollar was having problems. Foreigners were demanding gold. The London gold pool was established for a short amount of time to help manipulate the gold price. Foreigners then, as they started trusting the U.S. less because of all the guns and butter policies, the stagflation policies in the 60s, 50s, 60s, 70s, foreigners started demanding their gold. So it looks like we're starting to see some of that with a lot of foreign governments and foreign central banks. If they are running trade surpluses, and there's a lot less countries that are running trade surpluses, they're not recycling those trade surpluses into U.S. treasuries. They're buying food, energy, and now they're starting to accumulate massive amounts of gold outside the United States.
Let me reset the room for the remaining minutes. Everybody here, please make sure you follow Jason Burack as well as check out his various interviews, his YouTube channel. We'll go to questions.
Oh, you mean in the Bitcoin camp versus the gold camp, and how they're not everyone, but there's a certain percentage of people that I'm all in on Bitcoin and crypto, I'm all in on gold and silver, and they just relentlessly make fun of each other and criticize each other?
Speaking from my own experience, and I'll add to Chio's point, I think it's a broader point of why is it that there hasn't been bigger allocations to gold, even not just in terms of crypto substitutions, right? But why is it that advisors, institutional players, even retail are not trying to place gold? Now, from my perspective, I've always given the answer that gold probably gets momentum if there ends up being a feeling of a prolonged bear market, because gold is a phenomenal diversifier because it doesn't really correlate to anything. So you need to have a belief out there that we're in a prolonged beta bear market so that you have at the margin more allocators saying, I need more diversifiers than just equities or bonds. But yeah, let's kind of go with that, Jason, as an offshoot to Chio's question.
So for generalist money managers, historically, the reason they say, and I've had a lot of conversations with them over the years, they say they won't allocate to gold is because, number one, they can't value it. So it's the old traditional Warren Buffett analysis of gold, the Seth Klarman analysis of gold and mining stocks. They don't want to be involved in a commodities, natural resource type business that's high capex, even though risk reward, there are certain times where you could make, in a certain part of the cycle, you could get really good risk reward for some of these natural resource companies, whether it's uranium, potash, oil, natural gas, gold miners, gold royalty stocks. But certain generalist money managers who are very traditional, they either can't value gold. I've heard a lot of people say that they don't understand gold supply and demand. Traditionally, gold has done very well when currencies are unstable, when there's problems in the global economy, if there's problems with government bond markets. So gold tends to do well during worries about inflation, although it hasn't done well in the last 2.5 years. Especially the silver price. But I'm talking over like longer cycles, financial history. Historically, 1970s, gold did very well during inflation. Other periods of inflation, gold did very well. And in other countries, right now, other currencies, the gold price is at or near an all-time high. So it's really the US dollar gold price that has not done very well. I think crypto has taken out a lot of that, but I think it's a lot of people don't understand gold supply demand fundamentals. They look at the above ground gold supply and say there's too much supply and demand is not going to increase enough to cause supply problems, and we're not going to get a big spike. Or they say that I can't value gold, the traditional generalist money manager types, because normally you need a certain type of background. You went to a certain type of business school. You have a PhD in economics, those types of money managers, that they won't touch gold for those reasons. My point, though, is if we have more bankruptcies, we have really bad bouts of deflation, or we have a bond market scenario, government bond market problem in Japan, the United States at the same time, that would be good for gold. So I think we're starting to see that environment occur over the next 6 to 8 months. I think we're starting to see a lot of finance ministers admit that there are severe problems with a lot of these government bond markets. Historically, with government bond markets, historically with a lot of countries, you can either save your currency or you can save your government bond market. You can't do both. Japan has gotten away with it longer than anyone for the last 30 years. And Japan seems to have finally hit limits with the comments lately from the head of the Bank of Japan.
Yeah, and I've heard you talk about that before, Jason, this idea that the problem with deflation is that you can't really tax it, right? Like you can with nominal inflation. So it sounds to me like you believe that the only way out is ultimately through higher inflation, as opposed to sort of the debt
also yield curve,
reset, so to speak.
Yes. The government wants the U.S. government is the world's largest debtor. It's just pure math at this point, the amount of government debt. We're looking next year, 2023, we're looking if base case. So if the Fed keeps hiking interest rates, base case, we're looking at around $1 trillion just in interest payments on a rapidly growing national debt. I live right at 20 minutes right outside of Washington, D.C. I can tell, and I've lived here for 20 years, I could tell you that the majority, and I've spoken with bank lobbyists and political aides over the years, I have contacts in the political sphere here in D.C., that neither political party, the majority of neither political party, Republicans and Democrats, wants to seriously cut spending. So we're looking at around $1 trillion in interest payments on the national debt for 2023 if the Fed does not cut rates. So there are limits to this. The debt will never be paid off. But I think like all people really care about here in DC is being able to pay the interest payments on the debt. So as we get to those problems, I think those are all good for gold. Japan appears to be hitting those limits first, though. That's not what I said in the 1920s, because FDR actually tried making it almost impossible for Americans. There was, I think at the time, there was a $10,000 fine if you got caught with your gold. So a lot of Americans actually were taking their gold and either they were hiding it or they were driving up to Canada and putting it in banks there. But the gold miners, my point about the 20s was there was deflation. The government's allowed some deflation before massive amounts of intervention. And the deflation and the bankruptcies actually caused a lot of people to go away from stocks and bonds and other things that could default, and more people were going into gold. So there were private sector problems in the night after the 1920s, October 1929 crash. And the gold miners actually, their profit margins expanded enormously because their costs were falling and the gold price wasn't falling. So it really depends. If you're looking at the gold mining companies, it depends on profit margin. So in a deflationary environment, if the gold price goes down less than other assets and energy prices fall, that would actually be bullish for a lot of these gold miners for their for the underlying business, the profit margins. That was one of the main points I was making, not necessarily lack of faith in government. There was also an enormous amount of private sector defaults post-October 1929.
I'd also add, I think Vincent Delord made this point before, and I think it makes sense that inflation and lack of trust in the government is related, right? That if you have the constituents of a society not trusting government, they end up spending faster. That creates sort of a self-filling cycle of higher prices. So I don't know if they're necessarily mutually exclusive. Let's keep going, though, with the supply and demand dynamics for various commodities. So we touched on gold. Let's talk about fertilizer and then uranium. So you made the point to me, Jason, that you believe that fertilizer is in a real longer-term bull market. Make the case for fertilizer, and what are some of the best ways investors can get access to that theme?
Okay, so there's a lot, for your listeners who are not aware, there are a lot of fertilizer producers in the United Kingdom and Europe that are offline. Fertilizer, a lot of the components is natural gas based. So if your local natural gas price is 2, 3, 4, 5, sometimes even 10 times higher than the US natural gas price or the Canadian natural gas price, your fertilizer company is at a severe disadvantage. So my point was that the US and Canadian fertilizer companies are in a good relative position right now because you have, I think in the European Union, you have almost, according to some reports, around 70% of their fertilizer capacity is uneconomic and offline. And Europe is going to have to, European Union and United Kingdom are going to, as long as their natural gas prices don't miraculously fall, they're going to have to import a lot more fertilizer, and it's going to have to be from U.S. fertilizer and Canadian fertilizer companies like your Nutriens, your Mosaics, your Intrepid potashes. So that would be one of the ways to play it. There's also, if you don't want a CapEx exposure, another way would be the Jim Rogers Raw Materials Commodities Index, or an exchange traded note that tracks the index. So that has like a diversified basket of agriculture, mostly agricultural commodities. I think it's about 10% per agricultural commodity. And it's got like a nice diversified basket of the soft commodities. And so that one has actually done pretty well over the last 12 months. You said you want to talk about uranium too?
Yeah, and uranium is an interesting one because the demand is going to be a function of longer term dynamics. And it doesn't seem like it necessarily wants to move unless there's some catalyst. But yeah, make the case for uranium broadly as well.
So nuclear power is the most energy dense. It's the most efficient by far right now of any of the technologies we have at producing cheap electricity. And this is a major, major problem. We're seeing this with all the manufacturing powerhouses all over the globe in China, Japan, Germany, the lack of cheap electricity. So we're seeing recently in the headlines that Japan, because they've been importing so much oil and natural gas lately, a lot of these countries that used to run enormous trade surpluses are not running trade surpluses that they used to. That one of the major reasons is they have to import so much fossil fuels and energy. So they're importing so much raw materials, energy costs, that they're not able, and their profit margins for their manufacturers are getting killed. So nuclear power would be a really smart solution long term, because it's not a short-term solution, Michael, because it's really, unless you already have a nuclear power plant already built and you're restarting it, building a nuclear power plant from scratch in most of these countries, unless it's China, it takes many years. It takes millions of dollars in the permitting process. You have to get all these permits filed, and then over $1 billion in capital costs, and over a decade normally to construct nuclear power plants. So this is a long-term play. The uranium and nuclear power was in a major bear market since Fukushima, and there was a mini bull market over the last 12 months or so, give or take. So it's been mostly since Fukushima, which was, I think, 2012 or 2013. It was a bear market for a very, very long time, almost a decade. So I think a bull market in uranium is just starting. And really, it's the only, as of right now, long-term viable solution for cheap electricity for a lot of these manufacturing countries, because nuclear power is the most energy dense. The other compromise fuel is natural gas, but there's also problems with coal. So the coal companies, if they can actually, or if they're actually allowed to mine, China's back to importing record amounts of coal. But they're really on the coal side, they're really the only demand driver story on that. So nuclear power, you have bear market, you have new nuclear power plants that will be coming online, and you have higher other energy prices, and you have governments that are starting to look, saying, well, what are we going to do with our companies and our manufacturers? Are we going to keep subsidizing our large manufacturers or large corporations to keep them in business? Or are we going to make long-term investments to find our manufacturers cheaper electricity? So I think it's a longer term thing over the next 6 months. Uranium and nuclear the bull market may not restart, but that might be a good accumulation opportunity in the short term for companies like Cameco, CCJ, and the other low-cost producer on the London Stock Exchange, Kazatomprom. There's also the Sprott Physical Uranium Trust, and I think right now it's trading at a 10% discount to net asset value. But the swings in net asset value for the Physical Uranium Trust, that's just a pure play for uranium on the spot price. The swings on net asset value between discounts and premiums, those can be, if you go and look at a chart of the swings on net asset value, those can go pretty crazy.
It just seems to me that for all the talk around uranium as a bull case, that you can see it coming and you just need to wait for the catalyst, right? Because to your point, the permits have to be in place. You have to, this is a very kind of long term type of bet. So it doesn't seem to me like there's necessarily urgency to buy into the uranium thesis unless you have an imminent major catalyst, like a country suddenly saying we're going to open up 5 reactors.
Yeah, and 5 reactors from one country, unless it's Japan restarting or Germany restarting or France restarting a lot of their nuclear power reactors, that's not going to move the needle. So if it's a smaller country and they're building a few reactors, it's not going to do the needle. But the large suppliers of uranium, they're not bringing on new supply. So they're not going to flood the market. This was a problem. And this is one of the major, besides Fukushima, which made so many politicians and regulators and people anti-nuclear power for so long. You also had the world's largest uranium miner and lowest cost producer, Kazatomprom. And for many years, they just kept flooding the market with more and more uranium supply. So the Japanese Nuclear Power Agency and the companies that own the nuclear reactors in Japan, they were selling post-Fukushima. They were dumping their extra uranium supply back onto the market because they were shutting down their reactors. And then you had Kazatomprom, which was the lowest cost uranium miner. They were increasing uranium production during the bear market post-Fukushima for 7 or 8 years. So that extra supply kept flooding the market. I would say that that's gone. So as long as that extra supply doesn't come back on the market, you have more, and you don't have another Fukushima type accident, because that's always a risk with uranium and nuclear power. Is you have an old reactor and then something unexpected happens. You like Fukushima, you have an earthquake, a tsunami, and then the reactor fallout. So that was like three bad things and 3 horrific things in a row, all exposing. But as long as those things don't happen, you will have a very nice uranium bull market, I suspect.
Yeah, and I would think actually, not that you ever want to see this happen, obviously, but a lot of, as I said, a lot of uranium comes out of Kazakhstan, right? So to the extent that
that's Kazatomprom. Yeah, that's Kazatomprom.
Right. So to the extent there's ongoing conflict with Russia or other geopolitical things that come up, that might actually be, I would think, more of a immediate catalyst than suddenly building up a whole bunch of reactors.
Well, you also have, and unfortunately the terms of the deal were not disclosed because it's with the Chinese government, but Cameco just announced that they signed a major long-term supply contract with the Chinese Nuclear Power Regulatory Authority to supply the current and future nuclear power plants. So it sounds like it's a big contract. Unfortunately, the terms were not disclosed publicly, but Cameco just also bought, and Cameco is like the player in Canada. They're vertically integrated. So they own uranium mines, they own they operate nuclear power facilities, and then they just bought Westinghouse, which is the original equipment manufacturer for a lot of the key components. They bought it with an infrastructure company. So key components to build these nuclear power plants. So they're going to be vertically on paper. This looks good for Cameco long term, that they're going to have higher profit margin and exposure throughout nuclear power and uranium mining. So it's not just uranium mining, but sometimes with these commodities businesses, Michael, when they try to vertically integrate, it doesn't go well. They waste capital, and it becomes like the worst case scenario, like Peter Lynch diversification, where they just run these different types of businesses in the industry, in the value chain. They just run them inefficiently. But they are working with a well-respected infrastructure company on this. When they bought Westinghouse, it was a joint venture deal. So maybe that will help. So on paper, that deal looks promising for more exposure to additional nuclear power plants that will be built globally.
And maybe for the remaining a few minutes here, again, everybody, please make sure you follow Jason on Twitter and check out his research and his conversations with other thought leaders from a supply-demand perspective, again, in the commodity space. What should people maybe avoid? Where is the supply-demand really weighted more towards supply than demand to just totally not even consider?
I think people should stay away from a lot of the base metal companies unless they're doing an enormous amount of research on cost, because a lot of these base metal miners, the thesis was China was going to keep building more and more single family homes, more and more apartment buildings, more and more commercial buildings, more skyscrapers. And unless China announces another many $1 trillion stimulus, and at this point, I mean, China has way too much debt in their economy. I don't think they could handle that type of stimulus. They just announced the People's Bank of China, their central bank, just did similar policy moves to what the Federal Reserve Bank did during our real estate crisis and housing crisis in the United States in 2008. They cut the bank's reserve requirement ratios yesterday, actually, and then they're trying to inject some more quantitative easing to keep their bank's balance sheet solvent. So the base metal miners for a lot of these, so that's like iron ore, some of these other base metals, the narrative was demand was going to grow enormously because China was going to keep growing. China was going to keep doing infrastructure. China was going to keep building. But at some point, though, you're going to have a bear market rally or a nice little pop, though. Maybe it's a short-term trade, because if the base metals do drop below a certain price, then you have a bunch of supply offline. So that's kind of how these commodities work in cycles, where longer term for some of these base metal miners, there's going to, other than probably copper, a lot of these other base metals are looking at the former tailwinds from the China bull market thesis of China growth. That's going away. But at a certain point, if their costs are rising and the metals prices are falling, then you're also looking at mines shutting down and supply side problems. So you're looking at a lot of volatility and in a bear market rally too. But longer term, some of these base metals, the supply demand fundamentals are breaking down because of China slowing down enormously. Well, they're having let's be honest, China's having a tech bust and a real estate bust.
Yeah, no, I think that's a good way to frame it. All right, so I think we're at the top of the hour here. Everybody, again, appreciate those that keep joining these spaces. Jason, first time you and I are chatting. Appreciate your knowledge. Thank you for spending the hour with us, and everybody enjoy the rest of your evenings or wherever you are in the world, whatever time zone you're in. Thank you, everybody. Thank you, Jason.